Investing is one of those things that everybody tells you need to do, but I have yet to find somebody to tell you how to get it done and how to explain it. That is why in this video, I am going to break it down for you, give you all the basic information on what types of investments you need to be looking at, diversification of your investment portfolio, and how to choose investments. But before we get started, you know what to do. I want you to like, comment, and subscribe so I can make sure you don't miss out on any wealth building information. Let's get after it. First, I want to define for you, what does it mean to be investing? Investing means that you are going to be putting your money in some type of investment vehicle for the long haul. When a person is investing, they are looking for returns on their investment, a payback. So that's the first thing that I want you to know, because I think sometimes people think investing just means I'm gonna set some money to the side and I'm gonna go grab it in a month or in 2 months. So investing, number one, is for a long-term play. I am investing for not this year, but next year and future years. I just think that's so mission critical to just even understand what investment means. It took me a while to understand that. So my goal is to make sure I'm empowering you so you will know exactly what that means. Now that you know what investment means, I want you to understand the basic types of investments. What is an investment? When people typically talk about investments, they're typically talking about stocks, they're talking about bonds, they're talking about mutual funds. But what exactly is a stock? What does that look like, feel like? Let me give an example. When a person is talking about investing in stocks, they are talking about investing in the equity ownership of a company. Let's talk about Facebook. When Facebook went public years ago, they were selling stock. And anybody that purchased stocks in Facebook, you really got a piece of paper. Yes, a piece of paper for exchange of your investment in that company. You got a share or half a share of stock. And so it's really important to understand that investing in stocks are investing in companies that are going to return you back money. That's the theory behind that. Now, we also need to talk about bonds. What are bonds? Bonds are typically investment vehicles that governments, municipalities, cities, and states actually issue bonds to raise money for their purposes. Our federal government has bonds. Our states have bonds. And when you are invested in bonds, you are typically going to get a great return on your investment, a higher interest rate for a period of time. Bonds are typically safer than stock because stock typically goes up with however the market is reacting to any news. So if the market is reacting to them talking about interest rates are going to increase, if the market is reacting to something major going on, stocks are moving up and down, but bonds are typically going to be a very solid investment for the long haul. The third type of investment is typically mutual funds. What are mutual funds? Like, that used to be so confusing for me. So mutual funds are where you're going to invest in a fund that has mutual understanding. Maybe you're going to invest in airplane stock, and maybe that mutual fund has a bunch of airplane stock. Maybe it has United, maybe it has American Airlines, maybe it has not Spirit. Maybe it has any of those, right? So a mutual fund is stocks that are mutually in the same category. And so you're getting to put in your money and invest in a bunch of different stock. So you might even have a mutual fund that is invested in like technology stock as an example. So just want to make sure that you understand the different types of investments. Investment approaches. There are two typical types of investment approaches. There's value investing and growth investing. Value investing is where you're out there looking for stock that is undervalued in the market. Let me give an example of that. When COVID hit, none of the airlines were flying. I went out and I invested in airline stock because that stock had taken a major dip. I knew that that airline stock was going to come back, so I was able to purchase that stock undervalued for half of its price. Now, when you're doing value investing, you really got to be paying attention to what is really going on. And this is where you're getting a little bit more sophisticated in your ability to be able to invest in stock. The second type of investing is growth investing. And this is where you are watching a company, for example, and you know that that company has such a great trajectory for growth. Let's think about that, for example. Let's think about AI as an example, artificial intelligence. That is the buzzword. It is everywhere. So any of us that are doing investing, and I preface that with I'm not a financial planner, but I am a pretty smart girl. So anybody that's doing any type of investing, I would be looking at investing in something that's dealing with artificial intelligence, because that is where the future is going. And that is going to be stock that is probably going to grow and grow and grow and grow. Can you imagine if we invested in Apple stock before Apple became a thing, or Amazon stock before Amazon became a thing? Think about, in terms of growth stock, what types of things are growing that you may be interested in, and you want to actually hedge that market. You want to get ahead of it so that you can actually have stock that you're investing in for the long haul that is going to grow, and eventually you can sell it and sit back like a fat cat. Diversifying your investments is so important to make sure you're always diversifying investments. Diversification means don't put all your eggs in one basket. It really just means that you are out thinking about, I want to go shopping for a dress as an example, and I want to make sure I go to multiple stores before I choose the very first dress at the very first store that I see. Diversifying your portfolio means you're going to invest in a little bit of everything. Maybe you're going to invest in stocks. Maybe you're going to invest in mutual funds. Maybe you're going to invest in real estate. Maybe you're going to invest in bonds. And if you're only going to invest in stocks, diversify the type of stocks that you're investing in. As an example, I might want to be invested in tech stock. I might want to also be invested in some type of stock in the retail market, some type of stock that's dealing in medical professional. You can diversify in the same class of asset and not necessarily have to be in stocks and be in real estate and be in companies and other things. But just realize when you are investing, think about it like a teeter-totter. I want to make sure that when I am investing, that if one stock goes up and the other stock is down, I'm balancing out. If all of your stock on the day that we closed down our economy was an airline stock and you needed to retire on that day, could you imagine? Your stock would have been really, really down. But if you had also invested in healthcare stock, you would have had a down portfolio in airlines, but an up portfolio in healthcare stock. So understand diversification. Just minimize your risk. And you always want to think about risk. But when you are investing, you got to think about risk from a long-term perspective. I want to make sure you understand how to evaluate investments. When you're thinking about evaluating investments, this requires you to do your own due diligence. Now, I want to make sure that you realize that when you're starting out to do investing, I'm going to always say to you, play it safe in the beginning, work with a financial planner that is used to working with people of your caliber. And when I say people of your caliber, there's financial planners that work with people that are just starting out, people that are at mid-level in their careers, people that have a ton of money, and it doesn't matter if they lose $1 million. Well, it matters to Carla if she loses $1 million. So I want to make sure that you understand that when you are evaluating investments, you have to look at a very few things. You got to look at who owns this type of investment. What is the long-term play for this investment? Is there growth in this particular investment? Allow me to give an example. If you were invested in, say, for example, Netflix, is there long-term growth in Netflix? What is Netflix looking to do? You can easily go online and you can read about these various companies. Find out what their long-term plans are. Are they stuck and aren't going to be doing anything different? If they are, then probably chances are that investment is going to hit a cap and it doesn't have any place to go. But if you are investing in a company, for example, that just decided they wanted to start Threads, they are growing, they're doing different things, that's probably a company I would consider investing in because it has long-term growth. You also want to look at the profitability of those investments. What has happened historically? History does tell us stuff. As much as we try to say things do not change, we got to look back and see what history tells us. If you've been profitable from historical, then chances are you're going to be profitable moving forward. So you definitely want to look at that. You want to also look at any regulatory things. And when I say regulatory, if you were investing, example, in real estate, I would go down to my local city, municipality, and find out, are there any rules and regulations, any type of new bill that's coming in, anything that I should be aware of before I put money in that type of investment. Most of these companies that we are investing in, stocks and things of that nature, they have to do what we call a 10K reporting. That's a report they have to file every year with the SEC. And in those reports, it talks about a lot of different things. So do some homework when you're getting ready to evaluate your investments. It's so important. Do your own due diligence. If you're a little scared, work with a financial planner. If you're looking to start off and do something on your own, go to a company where you can start doing some investing on your own. But again, diversify. Don't put all of your eggs in one basket because it's so important that you are able to keep your money. When you are investing, you're not investing to lose, you're investing to grow for the long haul. I don't necessarily believe in losing money. I know that stocks are going to go up and down, but I need to start seeing some turnaround. This girl is going to jump out of that and jump into something else. So make sure your plan is smart. Make sure you're educating yourself, because the most important thing is that you are going to be building wealth for you and your family, one investment at a time. And so now that I've told you what an investment is, I told you the types of investments, stocks, bonds, mutual funds. I told you the different type of approaches to investments, how to diversify your investments, how to evaluate your investments. And now that you know better, and you do, you absolutely have to do better. I want you to start investing, and I want you to like, comment, and subscribe so I can keep you updated on all things business and tax.